This is the third video in our series completing the master budget for a merchandiser. So far, we have completed the sales budget, the merchandise purchases budget, the selling expense budget, and the general and administrative expense budget. In this video, we will complete the schedule of cash receipts from sales and the schedule of cash payments for merchandise. We will begin with the schedule of cash receipts from sales. This is where a company will forecast when it expects to collect the cash related to the sales from the sales budget. Based on historical data, 60% of sales are cash sales collected in the month of the sale, 30% are collected 1 month following the sale, and 10% are collected 2 months after the sale. The sales for November through March are showing on the screen now. The January through March sales are from the sales budget, and the November and December sales are based on the company's records. The way we set up a schedule of cash receipts from sales is to have rows which represent the month of the sale and columns that represent the month of collection. Our goal is to find the total cash receipts in each of the 3 months that are part of our budget: January, February, and March. I like to work from top to bottom, 1 column at a time for this schedule. So we will start with the collections in January from November sales. Notice that January is 2 months after November, and our chart tells us that we collect 10% of the sales 2 months afterwards. So the amount of the November sales collected in January is 10% of the $25,000 November sales, or $2,500. Moving down, we have the December sales that are collected in January. January is 1 month after December, so our table tells us 30% of the December sales should be collected in January. 30% of the $30,000 in December sales is $9,000, so we add that to our table. Next, we have the matchup of January sales, which are collected in the same month, January. Our table tells us 60% of the sales are collected in the month of the sale, so we take 60% of the $33,000 January sales, which is equal to $19,800. The next row down is for the February sales collected in January. Unless our customers have a time machine, there's no way they will pay us in January for a sale that won't be made until February, so we can leave this cell blank. The same idea applies to the March sales. March sales will certainly not be collected in January. Let's move on to February. The first row is November sales collected in February. February is 3 months after November, and our table suggests that all sales are collected within 2 months of the sale, so we shouldn't expect any collections in February from November sales. Next, we have December sales that were collected in February. There is a 2-month difference between those months, so our table tells us that 10% of the $30,000 in December sales will be collected in February, which comes to $3,000. For the January sales collected in February, the 1-month difference tells us that 30% of these sales should be collected. 30% of the $33,000 sales comes to $9,900. For the February sales collected in February, we use 60% of the $38,500 February sales, which comes to $23,100. Hopefully you can verify that February collection of March sales would require time travel, which is not possible with the technology available as of the time of this recording. So we will leave the last row blank for February. Okay, now I've done the 2 columns with you. Take a minute on your own to pause the video and see if you can calculate the collections in March. I'll be back in just a moment with the answers. Okay, we are back with the collections in March, which are $3,300 from the January sales, $11,550 from the February sales, and $26,400 from the March sales. The calculations are showing on the screen now if you'd like to check your work. Finally, we can add up the collections from each month to get the total cash receipts. For January, $2,500 plus $9,000 plus $19,800 equals $31,300. Adding up the other 2-month collections in a similar way gives us $36,000 for February and $41,250 for March. That completes our schedule of cash receipts from sales. One final thing to note is that if we take a peek at our balance sheet, we see that the accounts receivable balance as of December 31 is $14,500. That should be the same as all of the cash collected from months in the previous year, and indeed it is. If we add up the cash received from November and December, we have $2,500 plus $9,000 plus $3,000, which equals $14,500. Next, we can move on to the schedule of payments for merchandise. Historical data shows that 80% of purchases are paid for in the month of the purchase, and the remaining 20% is paid in the month following the purchase. The merchandise purchases for January, February, and March are showing on the screen now from the merchandise purchases budget. The schedule of payments for merchandise has a similar form to the schedule of cash receipts from sales. We have the month of payment as the columns and the month of purchase as the rows. Our goal is to calculate the total cash payments for the 3 months in our budget, which are for January, February, and March. We can start with the December purchases that will be paid in January. Here we see in the balance sheet that the accounts payable account has an $800 balance from December, and let's assume that we know it will be collected in January. So we can enter $800 in the blank cell. Details in the problem will usually clue you in to when the accounts payable balance will be paid. Next, we need the January purchases that will also be paid in January. Our table tells us that 80% of merchandise purchases are paid for in the month of the purchase. So 80% of $19,600 from the January purchases will also be paid in January, which comes to $15,680. Any purchases in February or March can't be paid in January, lest we break the space-time continuum, so we will leave them blank. For February, we will start with the December purchases collected in February. Since all purchases are paid for within 1 month of purchase, and February is 2 months after December, we can leave this cell blank. For January sales collected in February, there is a 1-month difference, meaning that 20% of the $19,600 January sales should be collected, which is $3,920. February purchases paid for in February will be 80% of the $27,300 of merchandise purchases, which comes to $21,840. None of the March purchases will be paid for in February because, well, again, time travel. I'll give you a moment to see if you can find the payments for March. Pause the video, calculate your answers, and check back to see if you match what I have. Okay, the March payments and calculations are showing on the screen now. We have $5,460 collected from the February purchase and $24,640 from the March purchase. Adding up the total for January, we get $800 plus $15,680 equals $16,480 for January. And adding up the other 2-month payments in a similar way gives us $25,760 for February and $30,100 for March. Alright, that wraps up our schedule of cash payments for merchandise. Join us in the next video where we will continue with the cash budget and the budgeted income statement.